Welcome to another earnings reviews video. In this video, we're going to look at companies that reported earnings last week. And the goal here is, with this inflation going rampant, we want to find companies with the pricing power, most importantly, exercising the pricing power, and they also have a receptive customer. The consumer is receptive to price increases. Now, here are some of the companies that reported earnings last week. Among them, Tyson, Home Depot, Walmart, Lowe's, TJmaxx, Target, Nvidia, Cisco, Alibaba, Applied Materials, Workday, and Macys. Now, we have covered the earnings from Tyson, Home Depot, and Walmart in details in the video I released on November 16th. I'm going to leave a link in the description for that video if you want to refer to that video for these earnings. In this video, we're going to follow up and cover Lowe's, TJmaxx, Target, Nvidia, Cisco, Alibaba, AMD, Workday, and Macys. At the end of the video, we're going to revisit all of the earnings, not just from last week, but all of them from the weeks prior, for this particular season, for this particular quarter. We're going to look at names that exercised the pricing power and the consumer was receptive, at least during last quarter. These are the kind of names and kind of stocks that you want to be in, at least for now, as the inflation crisis continues to grow. We start with the earnings from Lowe's that we got last Wednesday. And of course, this came on the heels of earnings from Home Depot, which were decent, by the way. We covered those earnings. Revenues are up, net income is up, but most importantly, costs were pretty much under control. They did not go higher. As a matter of fact, went lower in certain categories. So let's see how Lowe's did head-to-head with Home Depot. Net sales last quarter were up 2.8% year over year. The gross margins were up 4% year over year. And this is the stunning finding, by the way. Expenses, specifically for wages, were actually down 8.3% year over year. And therefore, the net earnings for the company were up a stunning 274% year over year. Now, the mystery remains, why aren't Home Depot and Lowe's suffering from the wage increases and the labor shortages that we're seeing in other companies? The simplest explanation could be the fact that they're not hiring as much. I went to Lowe's just a few days ago. There were nobody there. Pretty much 3 people running the joint. But perhaps a more professional explanation is these companies, Home Depot and Lowe's, went through the labor wage inflation and the hiring last year. Last year, when consumers were stampeding on those home improvement stores, as the housing mania started, the lockdowns were in place and everybody had to find a hobby, something to do, Home Depot and Lowe's increased wages dramatically. And they have attracted workers, and these workers are still here. So unlike airlines and other retail stores, leisure, hospitality, restaurants, and other businesses that reopened this year, Home Depot and Lowe's don't have to experience the same struggles and challenges with wage increases or any labor shortages. They've already dealt with that last year, and now they can concentrate on hiking prices higher and therefore improving their margins dramatically. So these stores, Home Depot and Lowe's, remain good stocks, good companies to be in. Next, we have TJmaxx, and notice the contrast between TJmaxx and Lowe's. The net sales were up 24% year over year. Costs were up 25% year over year, dwarfing the increase in sales. And then we have wages, selling, general, and administrative expenses. These were up 15.5% year over year. And therefore, the net income is higher by about 18% year over year. So far, so good for TJmaxx, because so far the growth in revenues and sales is on par with the growth in expenses. The question is, can TJmaxx continue to increase their prices higher? And we know that cotton futures also exploded higher, so the next batch of goods are going to be more expensive for them. Are they going to increase prices in the next season? And will the customer be receptive? Or are they going to continue to hold on to their value proposition and eat the loss, the extra cost in cotton futures by reducing the margins? This is the challenge for now for TJmaxx. We don't have a clear indicator of what the strategy is, at least for now. Another element you have to keep in mind is, if COVID surges in upcoming months, how would that factor in? Because the rise in sales this quarter, last quarter, was due to the so-called reopening. And even amid the Delta surge, TJmaxx did pretty good. We have the upcoming holiday season, which is pretty good for kind of businesses like TJmaxx. But what comes after that? When the stimmies dry out, when the benefits dry out, what happens then? Will the consumer remain receptive to the price increases? This is the $1 million question. When we dig down to the categories and different segments for TJmaxx, as you can see in the United States, we have the Maxx. This is the clothing business. Sales were up 25% year over year. For home goods, sales were up 20% year over year. For TJX Canada, sales were up 27% year over year, and international sales were up 23% year over year. So far, so good. But we care about margins here, with this inflation surging higher. In the United States, for Maxx, the margins, profit, were up 49% year over year. For home goods, they were down 10% year over year. Now, in my household, home goods is my wife's favorite store. I'm pretty sure in your household, your wife, your girlfriend is also. The probability is, of course, that she's a fan of home goods. The reason is they have decent merchandise at lower prices. And it is part of the strategy of TJmaxx, by the way. Yes, they know that the margins are going to be lower at home goods, and therefore the design of stores is home goods way at the back and the clothing business right in front. So you have to walk through all of these racks of clothing before you reach home goods. So on your way out, oh wow, that's a nice jacket. What about these pants? And you end up grabbing something on your way out. This is part of the strategy, of course. But again, with this inflation happening, how come they did not increase prices in their home goods category? That is one source of concern here. Look at Canada. Profits were down 4.5% year over year. So the inflation over there is eating away their margins, or their pricing strategy sucks. They did not increase prices in Canada. On the other hand, TJX International profits were up 47% year over year. So I would give this report a B. It's okay for now, yet the future remains questionable at best. Next, we have Target. And notice the contrast here. One retail business gets an A, that's Lowe's. Another one gets a B, that is TJmaxx. And this one gets a C. And here's the reason. For Target, the revenues were up 9.5% year over year. Watch this. The cost of sales was up 10.3% year over year, exceeding the rate of growth in the revenues. Likewise, for selling, general, and administrative expenses, these were up 8.8% year over year. Therefore, the operating income was up 7.2% year over year, and all in all, the bottom line net earnings were up 7.4% year over year. So far, so good. They're not losing money. But here's the problem. Target did not exercise their pricing power. They're not hiking prices, and they are using the same strategy as Walmart, keeping the value proposition, which makes it a war, by the way, in the retail space. You have Target and Walmart saying we're not going to raise prices dramatically. We want to keep our consumers. We want consumers to move away from other retailers who don't have the leverage and the advantage, the size advantage that we have. So they're going to have to increase prices higher. The consumer will move away from these businesses to Target and Walmart because our prices are a lot better, and therefore our revenues will go higher due to the volume of sales. I understand the strategy, but it makes it a war, and wars are not good for profits or for stocks. You don't want to be in a war kind of stock. What I'm looking for businesses right now is to exercise their pricing power. And if they're not, then you're not good to me, because the strategy of the value proposition is promising, but the fruits are not going to be here maybe a year from now, when inflation gets worse, and who knows what's going to happen a year from now. We're looking for immediate strategies that we can see right now, we can reap the fruits right now, and therefore the stock of Target is down, and investors did not receive the report warmly. Let's just say that. Next, we have Nvidia, and we know that Nvidia is a growth monster. You're not going to find companies with this size in this market with this rate of growth, beside perhaps AMD. But even AMD is a lot smaller in size than Nvidia, at least in a market cap perspective. So that makes Nvidia an interesting animal, a unique animal in the stock market, a giant company with extraordinary growth. And here are the numbers. Revenues were up 50% year over year, and they were up 9% year over year. The gross margin was up 40 basis points quarter over quarter, and 260 basis point year over year. But perhaps even more important than the gross margins is the operating income. And this was up 9% quarter over quarter, and a stunning 91% year over year. And therefore, the net income, the bottom line of the company, was up 4% quarter over quarter and 84% year over year. What is the reason behind that? The pricing power. They continue to jack prices higher. Their business continues to expand. They're eating away business from Intel and other competitors. you're not going to find any business in this stock market with this rate of growth. And therefore, the stock continues to trade out of whack. The valuations don't make sense at all, but so long as the growth is intact, investors and market participants have the excuse to continue to pump Nvidia higher. It is the same excuse the market participants have with Tesla. Yeah, you say Tesla is overvalued, but the company continues to deliver growth quarter over quarter and year over year. And so long as that story remains intact, you still have the excuse for these companies to trade out of whack in terms of valuations. The moment the growth starts to slow down, and we've seen that, by the way, in Nvidia before, just a few years ago when the stock crashed. Once that happens, then it becomes a risky stock to be in because it's going to go down closer to fair value. But for now, it remains an ultimate growth play. Let's look at the different categories for Nvidia. For gaming, quarter over quarter, and I look for quarter over quarter, not year over year, by the way, because this is like inflation. We know the base effects, the year over year numbers are going to be stunning. We're looking for quarter over quarter, look for warning signs. Are they slowing down or are they continuing to grow? When we look at gaming, they were up quarter over quarter, data center up quarter over quarter, and this is the top line, of course, the revenues. When we look at professional visualization, for example, revenues are still up quarter over quarter. The problem is in auto, revenues were down quarter over quarter, and OEM and other, this category was also down quarter over quarter, dramatically. Now, these two segments, auto and OEM and other, yes, they're down quarter over quarter, but they remain a smaller segment of the overall revenue pie for Nvidia. And therefore, if they're down quarter over quarter, yes, it is a source of concern, but it's not going to impact the main business of the company. If gaming revenue starts to go down quarter over quarter, then we got a problem. But we know what's going on with auto. Manufacturing is down due to the supply problem. And when it comes to OEM and other, here's the explanation. Crypto mining revenue is down dramatically. Matter of fact, they describe it as Nvidia crypto mining chip sales fell off a cliff this quarter. You got to keep in mind, the crypto mining revenue for Nvidia is extremely small. The crown jewel of this business is gaming and data center. And these two categories continue to outperform, and therefore the growth in this company remains intact. On top of that, they're exercising the pricing power. They're charging more for gaming chips and data center chips. And for that, the company gets an A+ for this report. Next, we have Cisco, and the stock crashed after the report came out. And the reason is perhaps the font. I'm not joking. This is the report. I took a screenshot. I need a magnifier to look at these numbers. The stock deserves to go down 10% on that alone. But let's try to magnify this for you and see if we can read something. The revenue were up 8% year over year for Cisco. Net income, the bottom line, was up 37% year over year. So what is the problem here? These are good numbers. We will look at the revenues, the different categories of the business. The Americas were up 5% year over year. Europe, Middle East were up 11% year over year. And China, Asia Pacific, Japan, that category was up 15% year over year. All in all, the top line growth for Cisco was up 8% year over year. So what is the problem here? Why did the stock crash? When we look at gross margins, they're still good, about 64% in all categories and all regions. So what is the problem with Cisco? The problem is the forward guidance. For example, the revenue growth last quarter was up 8% year over year. Likewise, the earnings per share were up 37% year over year. The GAAP earnings were about 70 cents. Here's the warning and the sign for concern. The Q2 guidance, meaning this quarter that we're in right now, the expectations are for revenue growth to be between 4.5% to 6.5% year over year. This is down from 8% this year, or last quarter, I should say. Number two, the 2022 guidance says that revenues will be between 5 to 7% growth year over year. Again, this is down from last quarter, which was 8% year over year. Likewise, for the upcoming quarter, Q2, the earnings per share, the GAAP earnings per share, the guidance says it's going to be 64 cents and 68 cents. That's the range. Well, this is down from last quarter, which was 70 cents. Therefore, Cisco is saying perhaps The growth is peaking here, and this is exactly what market participants and investors did not like from Cisco's earnings. That opens an opportunity, by the way. What if the company beats on the guidance? That's a possibility, and that will surge the stock higher dramatically. But this is not an investment strategy. You gotta believe what the company says. If the company says our guidance is gonna be a lot worse than expected, it's gonna be lower than the quarter we're in right now and the quarter before, then we got a problem because they're seeing the business, the growth, peaking. So we're going to stay away from this one, with exception, of course, if let's say Q2 comes out and they say, you know what, we kind of underestimated the growth and now we have revenue growth of 9, 10, 12%, then the stock surges higher, but we cannot play this game. We cannot say, oh, the management's going to be wrong. You got to believe what they say. Next, we have Alibaba. And this is quite mysterious, by the way. I look at 3 different segments in Alibaba every earnings report. Number 1, the China commerce retail. Number 2, the international commerce retail. Number 3, cloud computing. All of these segments, magically of course, the revenue growth year over year was 33% exactly, okay? All in all, the top line, the revenues were up 29% year over year last quarter. So what is the problem here? Why did the stock crash after earnings? Let's look at costs, expenses. For the cost of revenues, they were up 50% year over year. The cost of product development, meaning R&D, that was up 25% year over year, still below the rate of growth in revenues. What about sales and marketing? What's going on here? The rate of growth in these expenses was up a stunning 85% year over year. And lastly, for salaries, administrative expenses, those were up 21% year over year. Even with all of that, the rate of growth in the business is stunning, 33% in the most important categories. So how come the net income went down 87%? What's going on here? The accounting doesn't add up. By my measures, of course, the net income should have read 10,000, and this is of course in renminbi. Instead, it reads 3,377, which means that the net income went down by 87% year over year. So unless I'm seeing or missing other expenses not in the report, I don't know what happened here. Or is this Chinese companies downplaying their profits to please Brother Xi and the agenda of common prosperity? Who knows? Because for all I know, sales for Singles Day exploded higher, all-time highs, and now dwarfing Black Friday. Black Friday and Cyber Monday in the United States of America doesn't even come close to Single Day sales. Now I know that the Single Day sales will be included in the next report, but still, the growth in Alibaba remains intact. So how come their bottom line is collapsing? And therefore I say stay away from Chinese stocks. Don't even try. You're gonna lose money. There is a battle here between the communist approach versus the capitalist approach, and I don't want to be in this battle. I don't want to invest in companies engaged in the battle of common prosperity, and whatever government measures will come to crack down on these businesses. Next, we have AMAT, aka Applied Materials. Let's see what's going on here. The net sales were up 31% year over year. The gross margins were up 2.7 points year over year. The operating margin, most importantly, was up 5.5 points year over year. The net income was up 51% year over year. No problems whatsoever here. And by the way, this is the core and the heart of the chips business. We had one warning from Nvidia that the auto industry, auto manufacturing is slowing down, and there is no end in sight for now. So any company that comes out, whether be it Ford, GM, or any other manufacturer that says, yes, car manufacturing will pick up dramatically in 2022, will the source chips manufacturers say no? Not so fast. And here are the details for AMAT's earnings. For the most important category, the semiconductor systems, net sales were up dramatically year over year. Most importantly, the margins, the operating margin was up 40%. We look at Applied Global Services, another segment for Applied Materials. The sales were up year over year, no problem here. The operating margin also improved to 31% from a year ago. In the last segment of the business, the display and adjacent markets, sales were down. And this is also related to the auto industry. Sales were down year over year. Margins improved by a little bit to 20.4%. And therefore, AMAT is also exercising the pricing power, even though sales slowed down. So why did the stock perform poorly after the report came out? Number one, the stock was already higher, out of whack. It already priced in all of these results, and then some. We also got a warning here that AMAT is blaming the supply chain problems for earnings and the forecast miss. That is the one. Forecast. Nvidia did not miss in the forecast. They did not downplay the forecast. But here we have the heart and the core of the chip industry. And they're saying, you know what? The supply chain problem is worse than we expected, and they're going to impact the forward guidance for the company. What does that mean? The entire chip manufacturing industry and the chip design industry will suffer as a result. So anybody that says the chip problem, the chip shortage will be alleviated next year, you have no idea what you're talking about. This problem will prolong, and it's going to start to dent the margins and, most importantly, the sales of these semiconductor stocks. Look at the lowest segments, or let's say the least important segment in Nvidia and AMD, the autos, visualization, etc. Sales went down, but the margins went higher. What does that mean? These companies are increasing prices dramatically to make up for the loss in sales. What if the supply chain crisis prolonged, and now we get a problem that the main segments in these companies, in Nvidia and even AMD, what if sales start to get hit in these categories? Yes, they're going to increase prices higher, but will that make up for the loss in sales? I don't think so. So are we seeing peak performance in these semiconductor chips companies and therefore their stocks? This is the $1 million question. Next, we have Workday. What's going on here? Revenues were up 20% year over year. The costs, all in all, were up 16% year over year, and therefore the net income actually went positive. All good results. The growth in revenues is exceeding the growth in expenses. The problem is there are some signs for concern here. When you dig down in the categories of expenses, for example, the costs for subscription services are up 32% year over year. The costs for sales and marketing are up 21% year over year. Now they can control those costs. So I'm not concerned about sales and marketing. I'm concerned about the subscription services costs and the general and administrative costs, because they were up 19% year over year. These are good results all in all, but you have to remember this. The stock surged higher in anticipation of these earnings. They front-loaded the earnings ahead of time, and therefore the reception and the reaction after earnings was not positive. Lastly, an interesting one from Macys. What's going on here? The comeback of retail. Is it or is it not? Well, we know that year over year is not relative here, so there's nothing to look at. Net sales were about $5.4 billion, okay. The cost of sales were about $3.2 billion, and the selling costs, marketing and salaries, etc., that was about $1.9 billion last quarter. All in all, the bottom line, the net income was about $239 million. Is this good or bad? Well, we have to pen these numbers with 2019 and 2018 numbers for reference. When we do that, you can see that the net sales for Macys are now exceeding 2018 levels, which was about $5.4 billion. Sales went down in 2019 to $5.1 billion, and now all of a sudden they're up again to $5.4 billion. When we look at costs, most importantly, this is the important one, by the way. The cost of sales was about $3 billion in 2018 and 2019. It is also about $3 billion in 2021. And this is, of course, for the same quarter. Likewise, when we look at the selling and administrative costs, in 2018, 2019, these were about $2.2 billion. This time around, they actually went down to $1.9 billion. Interesting, isn't it? And the net income, the bottom line, in 2018, it was $62 million. In 2019, it was $2 million. This time around, it is $239 million. So the bottom line for Macys improved dramatically. What happened here? The comeback of retail, you might say? Perhaps. But when we dig down, notice that sales recovered, yet the selling and general administrative expenses went down, meaning the store expenses went down. And that is due to two factors, by the way. Number one, reducing their store count, so stores that are not performing, bye-bye, these are gone. And number two, perhaps the surge in sales came from Macys.com, their online operation, not from store sales. And therefore, they're enjoying the lean operation. And the bottom line went up higher than 2019, higher than 2018. Very impressive numbers. Now, the $1 million question is this sustainable? Meaning, if the surge in buying from Macys.com and even in stores was due to the stimmies, then the stimmies are gone. And these numbers and these results are not sustainable. If the surge in sales was due to nostalgia from the consumer, that they want to go back to stores, I doubt it, because when you dig down, the majority of sales, the increase in growth in sales came from Macys.com. And I see that as perhaps peak sales for Macys. Maybe this quarter, the holiday season will be great for Macys, but after that, we're going to have a problem because the stimmies are going to dry out, the economy will tighten, and it will be the ultimate test for Macys. Can they continue to come back, or were the good results just transitory? We'll see. The bottom line here, folks, is the market is rewarding companies that are exercising the pricing power. With 30-year high inflation, investors are rewarding the retailers willing to hike prices for shoppers. Not Target, not Walmart, but the retailers who are hiking prices. The consumer has the AO for now after trillions of dollars in stimmies, crypto, and stock market gains. So I'd like to see companies hiking prices higher. These are the kind of stocks that I want to be in. We will look at the results that we got last week, which companies exercised the pricing power, and so far they have a receptive consumer. The answer is Tyson. I see Home Depot, Lowe's, Nvidia, and maybe Macys. It depends. We'll see. When we visit last week, or the week before that, I should say, there's nothing here. PayPal, AMC, Cody, Wynn, Bumble, nothing. Disney, certainly not exercising the pricing power. So I'm not seeing any name here that is exercising the pricing power and is worthy of buying. Of course, some certain stocks, the likes of Roblox and Trade Desk, are exploding higher due to short covering, but not due to any inflation dynamic. What about the week before that? We have plenty of names. We have Clorox, BP, Pfizer, certainly jacking prices higher for the government. They're paying over $500 a pop for the pills. Martin Marietta, same story. Qualcomm, Mondelez, Toyota, Kellogg's, Skyworks, Uber, Fortinet, and Airbnb. These are companies increasing prices and the consumer remains receptive. Now, you gotta be careful here. For example, I used to own Fortinet. The stock is out of whack right now, so the opportunity is gone. Perhaps the opportunity is in names like Clorox that have been underperforming for a while. Because when it comes to stock market investing, the entry point is important. So yes, the financials could be impressive. The company could be exercising its pricing power and the consumer remains receptive, but the entry point for the stock is not attractive. You got to do that analysis too. And lastly, what about the week before that? Well, we have certain names, the likes of Kimberly-Clark, UPS, 3M, Coca-Cola, McDonald's, GM, Ford, Caterpillar, and Chevron, all increasing prices and the consumer is receptive for now. Certain names you got to be worried about because what if we have a slowdown in China or lockdowns in other countries, say in the European Union? That makes 3M, Caterpillar maybe a little shaky here. Other names, not included the likes of Apple, for example, they certainly have the pricing power. They can increase prices and the consumer will pay. The problem is, are they exercising the pricing power? The answer is no, because they have a market share dynamic and they're not going to mess up with that, at least not for now. Anyhow, folks, I hope you enjoyed this one. And if you did, kindly press the like button and subscribe to this channel. And by the way, we're going to have the regular programming coming out this evening. Thank you for watching. Thank you for listening. And I will talk to you again soon.